Now that we have now that we know bonds may be issued at a discount or premium, how do we account for bonds when they are issued at a value other than face? Now remember, in video 1 we looked at a bond where the stated rate and the effective rate equaled. And in that case what happens is you actually have the bond issued at the face value. But if the stated rate and the effective rate do not equal, they're not the same rate, then we issue it at a discount or a premium. So let's look at the example again where we issued the bond at a discount and see how do we account for a discount on a bond. So again, Parker Company issues 750,000 8% 5-year bonds on June 30th. The bonds pay interest semi-annually on June 30th and December 31st. At the time of issuance, the effective rate for the bonds was 10%. So again, the first thing I always do is figure out my 5 things. What is our face value? Again, face value is 850,000. Stated rate on this bond is 8%. The effective rate on this bond was 10%. Again, this is a 5-year bond, and the interest is paid semi-annually. Very important that we know this. Now, the issue price. Well, if you go back and you watch lecture 2, we actually worked this bond problem and found that the issue price was $692,085. And remember, the issue price is the amount of cash that we receive. So when looking at this, since the issue price is less than the face value of the bond, this is a bond issued at a discount. This discount must be amortized over the life of the bonds. In other words, we allocate the discount across all the interest payments. This is a 5-year bond that pays semi-annually, which means there are 10 interest payments that will be done on this bond. We must allocate the amount of discount, which again, the discount is simply the difference between the face value and the issue price. We must allocate that discount across the life of the bond, each of the interest payments. Why is that? Well, a discount will cause the interest expense to be greater than the amount of cash interest payments. Remember, we said we calculate that cash interest payments by taking the face value times the stated rate times time. That gave you the amount of cash you physically pay every 6 months. Well, in this bond, since it's issued at a discount, the bond is actually priced to yield a different rate. So because we pay interest at a stated rate of 8%, that's the amount of interest we pay every 6 months. Or excuse me, 4% every 6 months, 8% per year. But that indicates the amount of interest we pay periodically. But the bonds are sold to yield a rate of return of 10%. Now again, we can't touch the 8%. The 8% is the amount of cash we have to pay each year on this bond. So where do we have the ability to change? Well, we have the ability to alter the issue price so that we can yield 10% to our investors. So what does that mean? Well, even though we pay cash every 6 months at the 8% stated rate or 4%, we must record expense that would show a total return over the life of 10%. Okay, so if that makes sense, that's why we have to amortize this discount. We have to allocate it out. So the amount of interest expense will be recognized, that we will recognize each period, will be greater than the cash payment because we're recognizing expense at 10%, so to speak, whereas our interest cash payment is only at 8%. Now, before we actually record the entries related to the bond, first we must create an amortization schedule so we can see how much discount we will be amortizing each time. There are 2 methods we can use to amortize the discount. We can either use the effective interest method or the straight line method. The effective interest method is the most common because it most likely represents the true accrual of interest over time, but the straight line can be used as well. So let's begin by using the effective interest method. Well, we signed this bond, we issued this bond on June 30th, so that's going to be our starting point. The first thing we do is on June 30th, we figure out what is our balance. So the first thing we need to do is find out the unamortized balance. This is the amount of the premium or discount. Now remember, we said the premium or discount is the difference between the face value. So we have a $750,000 face value, and we have the issue price of $692,085. So that means our discount in this case started out at $57,915. Again, the unamortized balance on issue date is simply the difference between the face value and the issue price. So subtract those 2 numbers, you find that we have a discount amount of $57,915. Now, since this is issue date, there is no interest yet. Remember, interest is a product of time, so it will not accrue until the next day. So that's when you start accruing interest. Now, what's the carry value of the bond? Well, the carry value of the bond is the bond payable netted with the discount. So on day one, the carry value of the bond would be the 692,085. How did I get that? Well, the face value of the bond is 750. Since it's a discount, you're going to subtract out the discount of 57,915. So when you do that on day one, you will always find that the carry value of the bond to start with on issue date will equal the issue price of the actual bond. Okay, 692,085. All right, so that's to start with. Now, the next thing we have to do is the first interest payment. So every time we have an interest payment, we're going to go in and calculate the interest payment. That's the amount of cash we're going to pay. We're going to figure out the interest expense and then the amount of discount. So let's talk about the interest payment. No matter what, whether you use the effective interest method or whether you use the straight line method, this column is always the same. You always take the fair value, or excuse me, fair value, the face value of the bond times the stated rate of the bond times the amount of time. So in this case, the face value again was $750,000. So to get this interest payment, we did it in a prior video, but let's just show you how it works. 750 times the stated rate of 8%, excuse me, times our time. This is a semi-annual, so it pays every 6 out of 12 months. And when you do that, you take 750,000 times 0.08 times 6 over 12, you get actually $30,000. Now, another way to do that is 750,000 times 4%. Some people will say that, well, all you're doing is taking the rate and splitting it in half. That is absolutely true in this case. So 8% divided by 2, 6/12 is the same thing as half, 1/2. So 8% divided by 2 gives you 4%. So 750,000 times 4% would also give you that 30,000 in interest. Okay. Now, the cool thing is once you calculate that payment once, the face value doesn't change, the stated rate doesn't change, and the fact that it's semi-annual every 6 months doesn't change. So the actual interest payment would be the same for every single period. Now let's look at the interest expense. The interest expense is how much you're going to actually record as expense. Now remember, since this is a discount, our cash payment's at 8%, but our interest expense has to be higher because we are paying a return out of 10% in total. Now, this is where we get a difference between the effective interest method and the straight line. Under the effective interest method, in order to calculate interest expense, you take the carry value of the bond. Remember over here, this column represents the carry value. You take the carry value of the bond times the effective rate of the bond times time. So in this case, what we're going to do is we're going to take a carry value of 692,085. We're going to multiply that by the effective rate of 10% times 6 over 12. Again, if you want to do this in your head, you can take the 10% times 1/2, which would give you 5%. So basically, we're saying 692,085, and we're going to times that by our 5% rate. So that gives us $34,604. Again, you get 25 cents, but we're going to round to the whole dollar. True rules of rounding. 5 and up, you round up. 4 and down, you round down. So 34,604 is what we're going to have rounded. That represents the amount of interest expense we're going to record. Now notice this is greater than the interest payment. When you have a discount, anytime you have a discount, the interest expense will always be greater than the payment because you are pricing your bond to yield a higher rate of return than you're paying out every 6 months, okay? So then the difference between these two numbers becomes the amount of discount that we're amortizing. So we're amortizing $4,604 in discount. Now what does that bring our unamortized balance to? Well, this column represents the amount of discount that's still remaining on our books. This column eventually has to equal 0. So if you were to do all 10 payments, all 5 years, I'm not going to in this video, by the way, that's way too much time, but you would actually have to take this all the way down to 0. So keep in mind the unamortized balance column must equal 0 at the end of the bond's life. So we're going to take that 57,915 and we're going to subtract the 4604 from it. So that leaves us 53,311. Now let's talk about the carry value of the bond. This column will actually flip. Since this is a discount, the carry value of the bond must go up. The reason being, at the end of the bond's life, and let me just add a column here. At the end of the bond's life, we must actually end up having a value here of $750,000. A bond's carry value must equal its face value at the end of its life. So when we get to the end of that 5-year period, the carry value of this bond will be $750,000 because that's the amount we physically have to repay to our investors. We have to write a check for $750,000 at the end of the bond's life. So the only way that we can go from 692 to 750 is to increase the value here. So what that means for us is we're going to take that 692.85 and we're actually going to add the 4604 to it. And that's going to bring us to 696.689. Again, we are a little bit off because we are rounding to the whole dollar here. So anytime you round, you have this issue. Now let's look at June 30th. The next interest payment will happen on June 30th, 2014. Again, the cash payment's always the same, but now we need to calculate the interest expense. So at this point, to do the interest expense, we would take the new carry value, which is 696.689, and we're going to multiply it by the stated rate times time. Again, or you can take 689 and multiply it by the 5% because we already know that 10% times 6/12 is 5%. It's 1/2. So go ahead and do that. Take 696, 689 and multiply it by our 5%. And you end up getting 34,834. I could fight either way because it comes out to 834.45, and I'm just going to follow that. That would be 834. Again, you would round the 4 to 5 and round up, but let's not get too complicated there. Let's just simply say, keep it easy. We're going to do 34,834. Now, how much does that bring us in amortization? Again, this column is simply the difference between the two, so that'd be 4,834. Remember, we said that this column is working its way to 0, so we're going to amortize out. So we're going to take the 53,311, we're going to subtract the 48,34, and when we do that, we get 48,477. Again, what did we say happens to the carry value of the bond? Well, the carry value of the bond actually will increase. So you're going to take the 696,689 because we're working our way up to face, plus the 48,34, and you get 701,523. All right, so pause the video for just a moment and see if you can go through and actually calculate the next row, the December 31st, 2014. All right, hopefully you've paused that out. And what you did is you took 701,523 times our 5%, which gave you, I hope, 35,076. Again, we've rounded that, which makes our discount amortization for the period 5,076. Now, what will that bring our unamortized balance to? Well, you take the 48,477 and you subtract the 5,076. That brings us to 43,401. And then last is our carry value. Again, our carry value is working its way up to the face value. So you're going to take the 701,523 plus the $5,076. Rephrase that. You get 706,599. And that would continue on for the next few periods until you fully amortize the bond out. Okay? Alright, so now that we've actually amortized, we are ready to actually record the journal entry. So let's look at how would we record the journal entry for this bond. Well, the bond was issued on June 30th, 2013. When we issue a bond, we receive cash, and we receive cash equal to the actual issue price, which was $692,085. That's the amount of cash we received. Now, we're going to have to pay back $750. So when we record the bonds payable, we're going to record it at its full face value. Well, that leaves us a difference of $57,915. Again, we got that by taking the $750,000 and subtracting the $692,085. Okay, what do we call that? Well, since the issue price was less than face, we call this a discount. So we're actually going to hit discount on bonds payable, and that's how we're going to record there. So the bond sits there and we come to the next big date in its life, which is December 31st. Again, we're at year end. We're not crossing a year end. So on December 31st, 2013, we make our next payment. Well, once you've done the bond amortization chart, you actually have all the information. We're actually going to simply journalize these first 3 lines here. We're going to do the interest payment. That represents the cash. So anytime you do that, I'm just going to make a note here that this represents the cash that you pay every 6 months. The next column represents the interest expense. So you're going to debit interest expense for whatever you have under the interest expense column. And then the discount is the amount of discount we're going to amortize. So we've got $30,000 in cash. Is that a debit or credit to cash? Well, cash is going down. We're paying this out, so it's going to be a credit to cash. So I'm going to go down here. Again, I'm following good journal form, so I'm going to go ahead and credit my cash down here underneath for $30,000. And then we figured out that our interest expense, remember interest expense is an expense account, so its normal balance would be a debit, so we need to debit that account for $34,604. Again, straight from our chart here. And that leaves us the discount. Now, do we need a debit or credit? Well, we need a credit of $4,604. That's going to be a credit to the actual discount on bonds payable. Discount on bonds payable is a contra account. When we show our balance sheet, we'll show the bonds payable. Then we'll show less the discount. In this case, it's a discount, so it'll be subtracted out. And that would give us our true bonds payable net that we would show on our books. So we physically would carry on our balance sheet this bond at $696, $689 at the end of the period. Because you net these two accounts. You net the actual bonds payable, the $750, with the balance sitting in the discount account. Okay? And that's what you carry. That's the reason it's called the carry value of the bond. That's the amount you actually report on your balance sheet for that bond. It would be the bonds payable $750 netted with the discount amount, which at this point is $53,301, which would leave us a balance on our balance sheet of $696, $689. Also, remember the discount started at a debit balance of $57,915. Remember that balance has to eventually be zero. Well, what's the only way you can get that to go to zero? Well, you have a debit balance. The only way to get it to zero is through crediting the discount account. So you should do the opposite here. All right, so the next interest payment is on June 30th. Again, we do not have to worry about the accrual because our payment was on December 31st, so there would be no interest that was not paid at the end of the year. So June 30th, again, we simply go and we would journalize this column. Interest expense would be our debit, $34,834, so $34,834. That would be the interest expense. Again, we know that the interest payment, our cash, is always the $30,000 from that column. So that leaves us with the amount of discount that we're actually amortizing. Discount on bonds payable, that's going to get amortized for $4,034. All right. That is the effective interest method. Now let's switch gears and let's look at the exact same problem here, only we're going to do the straight line method. Now the straight line method is a little bit different. Again, our starting point, excuse me, I put that in the wrong line. Our starting point is going to be the same. The actual discount amount is $57,915. The carry value is $692.85. The method here only impacts our interest expense and our amortization. Again, under the straight line method, you always calculate the first number here the exact same way. So we've already done that, and we already know that our cash payment every 6 months is $30,000. That will not change, does not matter what amount. Now, the difference between the straight line and the effective interest. When we look at the effective interest method, notice we calculated the interest expense and we backed into the amortization. Under the straight line method, we calculate the amortization, we back into the interest expense. So how do we do that? Well, you simply take the discount and divide it by the number of payments. So this discount amount was $57,915. So we're going to take, to find this column here, we're going to take the $57,915 and we're going to divide it by the total number of payments. Remember, this is a 5-year bond that pays twice a year. So when you take 5 times 2, that's 10 total payments. So when you take $57,915 and you divide that by 10, you get a total approximately of 5,000, you get a total of 5,792. Now we're going to have a little bit of a rounding issue because it really comes out to 5,791.50. That's okay. Remember, we're going to, for our examples, always round to the whole dollar. Now, The cool thing about straight line indicates that it's the same every single period. So once you get that, that means that's the same amount that you would recognize each and every period on this bond. 5,792. Of course, if we did all 10 payments, we would have to figure out the rounding issue, but that's it. Now, how do we get the interest expense? Well, since this is a discount, we know that the interest expense must be greater than the cash payment, right? Discount means the expense would be more. So all we do is we take the interest payment and add the discount amount. So it's going to be 35,792. This is only true if it's a discount. So keep in mind, if it's a discount, you take the interest payment plus the discount. Only for a discount. Premiums we'll look at in the next lecture, lecture 4. But for a discount, you take the interest payment plus the actual discount amount. Amortize, okay? Well, how do we get the unamortized balance? Well, we take the 57,915 and we subtract each time 5,792. So that gives us 52,123. And then again, you're going to subtract from that the 5792. That's going to give you 46,331. And then again from that you subtract the 5,792. That's going to give us 40,539. The discount, this unamortized balance, always works its way to zero no matter what. Now the carry-out value of the bond has to work its way to face value. Well, we're at 692. To work up to face value, we need to add. So we're going to take 692,085. We're going to add the 5,792. So that's going to give us 697,877. Whoops, typed that wrong. 697,877. Then we're going to add again to it the 5792. And that brings us to 703,669. And then one more time, we're going to add 5792. That's going to bring us here to 709,461. And we would continue that through the life of the bond. Now, how is our entries different? Well, on issuance, it does not matter. So this June 30th entry would be exactly the same. You still issued it at 692. You still carry the bond payable at 750, giving you a discount of 57,915. Now, our interest payments would actually be a little bit different. And why is that? Well, because we amortize using a different method. So the cash payment will still be 30, but notice our interest expense is 35,792. So when we record the interest expense, it'd be 35,792. 5,792, and then our interest payment would be 30,000. Now the cool thing about straight line, once you figure it out once, it is always the same. So that would be our solution there to do our journal entries under straight line method. Again, the difference, under straight line, you calculate the discount amount, you back into the interest expense. I hope this video has helped you understand the difference between the effective interest method and the straight line method for amortizing a discount.